We also had the WPI numbers, just an alert on that before we get you Mayuresh's take on the markets. On the macro front, September WPI contracted for the 11th straight month at a negative 4.5%. Food prices, however, have picked up, marking the end of a price depression. However, fuel and power saw the biggest slump, down almost 18%. What does that make of all of this? What's the expectation from the street, from big numbers from Z and Lever? Well, Mayuresh Joshi, fund manager at Angel Broking, joins us now. Mayuresh, great to have you on the show. I'm going to start by asking you about Lever because we are expecting numbers to come any moment. Last time around, there was a concern that despite huge ad spends, the volume growth was very tepid. What are you watching out for, and what's your call on the stock?
Afternoon, Mini. So clearly, I think if you look at the expectations in terms of volume growth, we are expecting a 6% volume growth. And clearly, I think if you look at the different segments, personal products, which accounts for 1/3 of their top line, is expected to show decent revenue growth of 9 to 10%. Shampoos, yes, as your analyst was mentioning, I think price cuts expected to come through because of the price cuts undertaken by P&G. So I think generally, I think the shampoos should underperform in terms of both revenue as well as the EBITDA margin front. Clearly, I think on the EBITDA margin front, expecting anywhere between 17.3 to 17.5%. And again, I think the gross margin expansion would be evident because of the falling input prices. So PFAD, lab prices have come down significantly, which would aid gross margins. However, I think sluggish top line growth is something that we are believing in for this quarter. And the management commentary will be very important, Mani. So I think what happens in terms of total discretionary spending with the way the monsoons have panned out. And clearly, I think the urban demand, if it stays up in midst of the competition pressures, I think is something to be watched out for. So the A&P spends are expected to be elevated at 15%. And valuations, again, on a trailing 12-month basis look quite expensive. So clearly, I think management commentary is going to be the key for HUL's performance going forward.
Gas-related stocks have gone up on Bloomberg News, Mayuresh, that the government could be mulling getting out of gas pricing and making it market-linked. It's a big deal for gas-based companies or upstream companies over there. What's the sense that you're getting? If this happens, would this segment go in for a major re-rating?
So clearly, one needs to understand how the mechanisms will go through, the timelines for the same as well, and what kind of linkages it will have probably to the international benchmarks. In my opinion, again, I think it should be more demand-supply linked because I think we are more demand-oriented rather than benchmarking against any international standards. Having said that, probably I think the impact on the upstream companies would start coming through. But clearly, I think one really needs to wait and watch. And again, I think the global gas prices itself are not at elevated levels. So I think how much incremental impact it will have on EPS of a lot of these upstream companies, one really needs to wait and watch. Sentimentally, I think the stocks might move, but again, I think the real impact will come through once the announcements are actually made and the timelines for the same are announced.
A quick take on TCS after the commentary from the management, Mayuresh. It's been a laggard if you look at the peers over the year-to-date period or a one-year period. Do you see it continuing to, underperform its peers?
So clearly, I think the stock might underperform for the next couple of quarters, and for obvious reasons. I think the second half for the IT sector as a whole is a painful one. A lot of furloughs come through in Q3, which means lesser working days. Q4, the demand environment gets firmed up, specifically on the client discretionary side. But having said that, I think TCS numbers did disappoint, both in terms of the dollar revenue, which came at 3%, constant currency revenue, which came at 3.9%. The volume growth, again, more or less in line with what we had estimated. The EBITDA margins and the EBIT margins more or less with the currency impact coming through. But again, I think what we look out for is probably the order book, which stands 30% more than their best order book. The utilization levels, even on a higher pace, including training, stand at 86.2%. And clearly, I think if you look at the management commentary, FY16 is more or less expected to be weak, with Diligent expected to post weaker numbers. Telecom, which contributes almost 9%, energy 4%.
I wanted a quick take, Mayuresh. I'm sorry we are running against time, but we also have a cabinet briefing that is scheduled. We will cut into that when the minister says something. But Mayuresh, quick take on 3-4 stocks. The first is Bharat Forge. It's got a huge downgrade by CLSA. It's been a stellar performer in its category, up 15% after this kind of correction from a one-year perspective. A marquee name. What's the sense you get after this 4% shave off here?
So clearly, again, I think the stock had outperformed. It had run up in terms of their earnings estimates. So I think within the auto ancillary space, we'll be extremely selective. We'll selectively look at a few tire companies where we believe, I think, the growth prospects still remain strong with input costs remaining benign. So I think tire companies, a few other companies like a Subaru, is something that we look at. But again, I think Bharat Forge is avoided at this point of time.
Shipping and aviation stocks again in focus. Aviation, a couple of days of follow-on buying. Anything that you like here?
No, again, I'm staying away from this sector. I mean, I don't understand this sector because I think the cash flows simply don't come through, and yet a lot of analysts become upbeat when the fuel prices start falling down. So I think that's one criteria from a trading perspective, but from a fundamental perspective, I think the cash flows structurally will not show signs of improvement unless many things happen for the sector. So again, a clear avoid at this point of time, but yes, from a trading perspective, the stocks might keep on moving.
Last question, we've also got Zee coming out with numbers. This is earnings season, Mayuresh. Where do you anticipate a positive surprise, and what are the themes that you're going with to your clients at this juncture?
So Zee, again, our take is that the advertising revenue should be quite decent, anywhere between 26 to 27%. The subscription revenue should also show an uptick of 15 to 16%. The phase 3 digitalization poses a huge amount of potential for Zee and a lot of broadcasters. But clearly, I think in terms of how the outlook map now for Zee TV, I think it really depends upon how the sports business might do. I think the entire management commentary is that the sports business losses will get curtailed to that 80 crore, 90 crore mark. And TV, the new launch, I think, will have substantial amount of capex on that front, which will keep the EBITDA margins between the 23 to 24% range. So again, declines, any shave off onto the stock post the results is something that I look out for, but I'll wait for significant declines on Zee. As themes, I think we just continue with our old themes that we like. I think private banking is something that we like. Select pharma, select cement names like Ultratech Cement, where we believe, I think the numbers might be soft, but over the next 3 to 4 quarters, I think the volume growth should start resuming. And again, I think with the kind of capacity additions they are doing, the EV to ton should start improving over the next few quarters. And select few mid caps, so something like Bajaj Electrical, Inox Wind is something we continue and prefer to buy.
Fair enough, Mayuresh. Thanks so much for joining us. We are still holding 8100 while European markets are looking weaker. If you can just pull that up for you, you'll see that the